You are listening to The Vocal Technologist. Spoken Tech for your ears.
By the time this deep dive is over, an autonomous AI agent will have negotiated a purchase, authorized a payment, and, audited a really complex corporate earnings report.
Right.
And it will do all of that without a single human ever clicking a mouse or looking at a screen. I mean, welcome to May 2026.
It's wild.
It is. The financial system as we know it, even just like 2 years ago, is completely unrecognizable today.
Yeah, totally. Because, the visual of finance used to be this absolute chaos on a trading floor.
Oh, yeah, guys shouting in jacket.
Exactly. And then it became a sea of analysts just staring at spreadsheets for 14 hours a day. But today, the real action is entirely subaudible. It's happening inside these massive server racks. It's driven by machine-to-machine communication that operates at a scale and, honestly, a speed that we are, frankly, just starting to comprehend.
Right. And mapping out that total ground-up rewiring of the global financial system is, well, that's our mission for this deep dive.
Cool.
So we have gathered a massive stack of sources for you today. We are looking at fresh May 2026 industry reports, some leaked internal fintech newsletters, and breaking macroeconomic news straight off the terminal.
Yeah, it's a lot of ground to cover.
It is a ton. But the core theme screaming from every single page of these documents is that finance is no longer about human analysts crunching numbers, and it's definitely no longer about you tapping colorful little buttons on a mobile app.
Not at all.
We are accelerating into a strictly machine-driven world. So, okay, let's unpack this, because we need to start with the institutional reality.
Right, this stuff happening behind closed doors.
Exactly. Before this revolution ever reaches your personal wallet, it is drawing its first real blood in the back office.
Yeah, look, we have to look at the sheer scale of the automation happening globally right now.
Yeah.
The UK government just commissioned this comprehensive report on the future of work, and the findings are, they're sobering.
For anyone in traditional finance, yeah.
Completely. They project that AI is set to automate 30 to 50% of tasks across most financial services roles within the next decade.
Wow, up to 50%.
Yeah. And we are not talking about a distant hypothetical here. This is playing out in the markets today. Standard Chartered, for example, is in the process of cutting 7,800 jobs.
7,800 jobs. That is roughly 15% of their entire back office workforce.
Exactly.
And if you look at the geography of those cuts, we're talking Chennai, Bengaluru, Kuala Lumpur, Warsaw.
The hubs.
Right, these are the massive offshore processing hubs. These are the engines that handle the data entry, the basic reconciliations, basically the foundational processing of global capital.
Yeah, the operational layer of global banking is just being fundamentally replaced.
Yeah.
Historically, if a bank wanted to scale up its processing power, what did it do?
It hired more people.
Right. It hired thousands of graduates in these global capability centers. But today, they're just deploying enterprise-grade AI models.
Which is wild to think about. If you are listening to this and you manage a team of junior analysts, the math changes completely today. You are no longer managing people. You are managing the models that manage the data.
It's a totally different skill set.
It really is. It feels like the entry-level escalator into Wall Street has just completely broken down. If you're a fresh college grad looking to build a career by doing, statement audits or basic earnings analysis,
Yeah.
Anthropic's Claude is already sitting at your desk. The sources show this deep integration of these models across corporate finance heavyweights. We're talking PwC, Goldman Sachs, Citi, Visa.
The biggest players.
Right. They are deploying AI agents specifically built for complex valuation reviews and reconciliations. But I have to stop here and ask the obvious question.
Sure, go for it.
If you eliminate the junior analyst who traditionally did all the grunt work, who is checking the AI's math?
That is the million-dollar question.
Right, because giving a large language model just free reign over a global bank's balance sheet sounds incredibly dangerous.
Well, what's fascinating here is that the institutions themselves are acutely aware of that exact risk. They are absolutely terrified of hallucination.
Oh, I bet.
So they aren't just cutting costs and hoping the AI gets the math right. They are demanding absolute auditability and governance. And that desperation for safety is precisely why compliance automation has become the single biggest enterprise market for AI right now.
Okay, I need you to explain how that actually works, though. Because compliance is notoriously dense.
Oh, it's terrible.
It's thousands of pages of obscure regulatory text. How does an AI reliably navigate that without hallucinating some weird loophole?
Right, so it really comes down to recent breakthroughs in multimodal reasoning and long-horizon workflows.
Okay, unpack that a bit.
Sure. Think about a legacy compliance department. It relies on massive teams of humans manually cross-referencing PDFs against Excel sheets, checking transaction logs.
Sounds exhausting.
It is, and it's incredibly prone to human error just through sheer fatigue. You stare at spreadsheets for 10 hours, you miss things.
Yeah, of course.
But a modern AI model can ingest a 500-page regulatory document, comprehend the nuanced legal definitions within it, and then cross-reference those rules against 1 million daily transactions in real time.
And it flags the anomalies.
Exactly. And the key is, it doesn't get tired.
Yeah.
It provides a deterministic step-by-step trail of its reasoning that human auditors can actually review.
That makes sense. You know, the sources highlighted something really counterintuitive about corporate risk that ties perfectly into this.
Oh, the laptop thing.
Yes. They brought up the protocol for when a financial institution loses a company laptop.
Right.
When that happens, the real cost the bank worries about is never the hardware. Like, the physical laptop is pennies to a bank.
Barely a rounding error.
Exactly. The catastrophic cost is the security and data risk of what is sitting on that local hard drive.
Yep.
But if an AI agent is handling all the sensitive data securely within a totally encrypted cloud environment, the physical risk profile of the workforce changes entirely.
Because the data never leaves the vault. And this highlights a broader truth about corporate software that people outside the industry often misunderstand.
What do you mean?
Well, consider why massive, clunky platforms like NetSuite or Salesforce continue to dominate the market.
Oh, because they're definitely not pretty to look at.
Right. It's not because they have beautiful, modern user interfaces.
Yeah.
Finance teams actively do not care about a shiny user experience.
They just want it to work.
They optimize for stability, auditability, and honestly, career safety. A CFO wants a governed system where every single action is logged and traceable. If something goes wrong, they need to know exactly why.
Which makes sense. And that corporate desire for absolute safety brings us to a massive battleground in the AI space right now.
The vendor wars.
Yes. If these banks are handing over their critical infrastructure, whose AI are they actually buying? The latest data from RAMP shows a major shift in enterprise adoption.
Yeah, this is a big surprise.
Huge. Anthropic has officially overtaken OpenAI in the U.S. business market. We are looking at a 34.4% market share for Anthropic versus 32.3% for OpenAI.
It's a significant milestone for Anthropic, undeniably. However, we have to look really closely at the volatility underneath those top-line numbers.
Yeah, the churn is wild.
It is. That same RAMP data reveals that 43% of Anthropic's users just switched over from another AI vendor.
Wow.
Furthermore, over half of these enterprise customers are currently paying for both providers simultaneously. They're hedging their bets.
Okay, I'm going to jump in here because those market share numbers feel like a total mirage.
How so?
Well, if 43% of Anthropic's users just abandon another vendor to get there, that doesn't scream sustainable adoption to me. That screams zero brand loyalty.
You're not wrong.
Isn't this just a trendy bubble where executives chase whichever model scored highest on a benchmark test that week? I mean, the Uber chief operating officer actually called out this exact corporate behavior in our sources.
Yes. Token maxing.
Yes. He highlighted this concept of token maxing. Explain that to the listener, because I thought it was fascinating.
Yeah, token maxing is a brilliant diagnosis of a very dangerous corporate habit.
Yeah.
Token maxing is when a company judges its AI success by looking at a dashboard of how many AI tokens its employees are consuming.
Like it's a high score.
Exactly. It is treating AI like a utility bill bragging to your board of directors about how much electricity your factory is using, rather than measuring how many actual profitable products are coming off the assembly line.
That is such a good analogy.
It is a vanity metric that looks really innovative on a slide deck, but it is weakly tied to actual business productivity.
So companies are burning through millions of tokens, just like chatting with large language models, but they aren't actually shipping useful workflows.
Pretty much.
They are just generating highly articulate summaries of their own boring meetings.
Exactly the problem. The real winners in the financial space are going to be the vendors that provide secure, integrated building blocks, not just raw conversational intelligence.
Right.
And Anthropic seems to realize this, which is why they are fundamentally changing their business model right now.
They aren't just selling the API connection anymore.
No, they recently launched a massive new consulting venture. It's backed by heavy hitters like Blackstone and major private equity firms. And they acquired a company called Fractional AI.
Wait, okay. If these AI models are so incredibly intelligent and capable, why does Anthropic need to build an army of human consultants?
Because enterprise plumbing is an absolute mess.
Fair point.
You cannot just plug a large language model into a 30-year-old legacy banking mainframe and expect magic. It just doesn't work.
It's all duct tape and legacy code back there.
Exactly. So Anthropic is sending human engineers physically into mid-sized companies to embed their models deep into the corporate infrastructure. They are building stickiness.
Ah, so you can't leave.
Right. Once that AI is woven into the daily reconciliation process, the company's never going to switch vendors just because a rival model scores 2 points higher on a benchmark.
That makes total sense. And you also see startups attacking this integration problem from a different angle.
Like Primitive.
Oh, yes. A company called Primitive just launched what they're calling an AI operating system, specifically designed for regulated financial institutions. Their entire pitch is containment. They keep all the data, all the model weights, and all the workflows completely isolated inside the institutional walls.
And we are seeing that same democratization of internal data with tools like Databricks Genie, too.
Yeah, explain, Jeannie.
Well, historically, if a business leader at a bank had a critical question, say, they needed to know the loan default rates in the Midwest for the last quarter, they had a process.
A slow process.
Very. They had to submit a ticket to the data engineering team, wait 2 weeks for an analyst to write a complex SQL query, and eventually get a static spreadsheet back.
The ultimate corporate bottleneck.
Precisely. But Databricks Genie attempts to solve that last mile of data access. That same business leader can now type a plain English question into Genie.
No coding required.
None. And the AI translates that intent into a highly optimized, auditable SQL query, retrieves the answer straight from the enterprise data lake, and presents it instantly.
Wow.
All while respecting the strict compliance access controls we talked about earlier.
It's incredible. So the technology securing and analyzing the back office has clearly matured. But the irony here is that while the banks are locking down their internal systems, this exact same autonomous capability is currently being handed straight to consumers.
Yeah, the retail side is moving just as fast.
Here's where it gets really interesting. Robinhood is now letting its customers use AI agents to make actual trades and execute credit card purchases.
Real money on the line.
Real money. And this isn't just a chatbot giving you generic advice on diversification. You open a dedicated, isolated account, which, by the way, is a very smart guardrail so it can't accidentally drain your entire net worth, and the AI acts autonomously on your behalf.
It is a massive psychological leap for a consumer.
It really is. You get push notifications when the agent makes a move, you have a real-time profit and loss feed, and there is a giant disconnect button if you get spooked by its strategy.
Which you might.
Yeah. It is like we are moving from driving a manual transmission car where you have to like clutch and shift every single gear yourself to just sitting in the back seat and telling a chauffeur where you want your money to go.
The chauffeur analogy is perfect because
Yeah.
it highlights the transfer of agency.
Exactly.
Jack Dorsey is entirely restructuring his company, Block, around this exact concept right now. He explicitly stated that Cash App is evolving from a peer-to-peer payment tool into a proactive, voice-driven AI financial protector.
Financial protector. That's a strong phrase.
It is. It will no longer just sit passively on your phone,
Yep.
waiting for you to send $20 to a friend.
Right.
It is designed to actively monitor your real-time cash flow, predict your upcoming utility bills, and autonomously take action to prevent overdraft fees before you even realize a deficit is looming.
Which led Bloomberg to publish a piece this week asking a really brutal question. Are fintech apps already dead?
It's a valid question.
I mean, if AI agents and embedded finance layers are just absorbing all these daily workflows, do we even need standalone banking apps anymore? If my AI agent handles my budget, why do I need a budgeting app?
The standalone point solution app is certainly facing obsolescence. We are witnessing the rapid rise of what the industry is calling agentic commerce.
Okay, let's dive into that.
For the last 20 years, digital commerce was human-centric. It meant you opening a web browser, navigating a merchant's website, manually adding items to a digital cart, and typing in a 16-digit credit card number.
A lot of friction.
Tons of friction.
Yeah.
But agentic commerce shifts that entire paradigm away from merchant-controlled websites toward machine-readable workflows.
Right, and the sources mention new protocols driving this, things like UCP and AP2. But hold on, throw those acronyms out for a second. What are UCP and AP2 actually doing in plain English?
Think of them as universal machine-to-machine handshakes. Instead of relying on a human to click through a website's graphical interface, these protocols allow your personal AI agent to communicate directly with a retailer's inventory system.
So no more clicking add to cart.
Exactly. Your agent handles the product discovery, negotiates the cart building, applies the optimal discount codes, and authorizes the payment autonomously in the background, entirely bypassing the traditional web browser experience.
So if the standalone app is dying, the financial companies that survive this shift have to scale up massively, right?
They do. They need to become comprehensive, full-service hubs.
Which is why we're seeing massive consolidation across the board. A wealth management platform called Farther just raised $150 million to scale up their AI advisor tools. Wealthsimple up in Canada is rolling out a massive suite of family and business tools, kids accounts with parental controls, integrated business lines of credit, just trying to become the single, inescapable platform for your entire financial life.
Yeah, and SoFi just bought a lending tech platform called Peach, so they can rapidly spin up new credit products.
Right. And we cannot ignore the infrastructure players providing the foundation for these hubs. The CEO of Marqeta gave a revealing interview about how they built a modern card issuing platform.
Marqeta's approach is fascinating.
It is. They essentially modularized the banking system. They separated the sponsor bank, the payment processor, and the consumer brand, providing the underlying Lego blocks for embedded finance. If your AI agent is going to autonomously spin up a single-use virtual debit card to buy your groceries through one of those machine protocols, it relies on Marqeta's infrastructure to clear the security and behavioral hurdles instantly.
And Plaid is doing something incredibly similar on the payment side.
Oh, yes.
Plaid used to just be the connectivity layer, the little pop-up screen where you enter your password to connect your bank account to an app.
We've all seen that screen.
Right. But now they are upgrading into core risk infrastructure. They are using AI models to offer guaranteed ACH payments.
Which is huge because ACH is that incredibly slow legacy bank transfer system that usually takes 3 to 5 business days to clear.
Exactly.
Yeah.
But Plaid's AI is now analyzing the transaction in real time.
The underwriting mechanics are what make this revolutionary.
Yes, because Plaid's AI is looking at your behavioral metadata.
Yeah.
What time of day you usually transfer money, your historical balance fluctuations, your employer's direct deposit patterns.
All the hidden data.
It calculates the probability of your transfer bouncing, and it does it in milliseconds.
Wow.
It is so confident in its mathematical risk model that Plaid spots the merchant the money immediately.
Wow.
They completely absorb the financial risk if the transfer actually fails days later on the back end.
That is incredible.
If we connect this to the bigger picture, it fundamentally redefines the consumer relationship with financial technology.
How so?
For the past decade, competition in digital payments was entirely driven by features. Companies competed on who had the sleekest user interface, the most gamified rewards program, or the easiest peer-to-peer splitting tool.
Right, the shiny stuff.
But the consumer experience is decisively shifting from features to trust. When you rely on a machine-to-machine workflow, you honestly do not care what the app looks like.
You really don't.
You care whether you implicitly trust the agent executing the trade, and you care about the infrastructure guaranteeing the settlement.
Trust is the new currency. But, there is a ceiling to how fast these AI agents can operate if they're still reliant on traditional slow-moving bank infrastructure.
A settlement lag.
Exactly. If your AI makes a brilliant trade or negotiates a purchase in milliseconds, it doesn't really matter if the cash takes 3 days to clear through the legacy system. That lag is exactly why the underlying plumbing of the money itself is shifting and why institutions are quietly rushing to adopt stablecoins.
Yeah, the macroeconomic environment and the nature of digital assets are experiencing a maturation phase running entirely parallel to the AI boom.
And we have to talk about Bitcoin for a second here because the irony of the current market is just delicious.
It really is.
Bitcoin's 30-day volatility just hit a 9-month low. The great wild crypto casino has suddenly become completely boring.
Who would have thought?
Right. Long-term holders and corporate miners are just selling options for steady income, which heavily suppresses the price swings. All the wild, speculative casino money has dramatically shifted away from crypto and poured directly into AI and semiconductor stocks.
Well, speculative capital always aggressively chases the newest technological paradigm.
True.
But while the retail speculators have abandoned crypto to chase artificial intelligence, the legacy financial institutions have quietly moved in to claim the underlying blockchain technology.
The plumbing.
Exactly. Stablecoins are currently undergoing a massive systemic institutionalization.
It is happening everywhere in the sources. SoFi just added its own proprietary SoFi USD stablecoin directly into its banking app for millions of everyday members.
Huge move.
And MasterCard Legacy, blue chip MasterCard, just secured a BIT license from the New York State Department of Financial Services to officially support digital currencies. You have massive payment processors like PPRO partnering with Coinbase to bring a complete stablecoin payment suite to everyday U.S. merchants. And blockchain.com just confidentially filed for a U.S. IPO.
Signaling that Wall Street is finally ready to welcome crypto brokerages back into the heavily regulated public markets.
Exactly.
And this brings us to the structural reality of stablecoins under the newly implemented Genius regulation framework.
Right, the new rules.
Critics often dismiss stablecoins as risky, unregulated private money. But this raises an important question. What actually constitutes private money?
Right, because most of the money you and I use every single day isn't physically printed by the U.S. government. When you log in and look at your checking account balance, that number on the screen is privately issued bank credit.
Precisely. The vast majority of the U.S. money supply already consists of privately issued bank deposits. But traditional banks operate on a fractional reserve system. They take your deposit and lend it out to someone else to buy a house or start a business, keeping only a fraction in reserve.
Wait, let's clarify that for a second. That mechanism maturity transformation, that is basically the classic bank run risk, correct?
Exactly.
Taking our short-term checking deposits that we might want back tomorrow and locking them up in 30-year mortgages.
That is the fundamental tension of modern banking. It creates systemic vulnerability. But regulated stablecoins under the new frameworks are structurally different.
How so?
By law, they must hold one-to-one reserves in highly liquid assets, primarily cash and short-dated U.S. Treasuries. They do not lend your money out.
So the money is just sitting there.
Right. So rather than undermining the financial system as early critics feared, they actually provide a safer, non-lending technological upgrade.
Wow.
They provide the instant programmable settlement that AI agents require, while potentially extending global demand for digital U.S. dollars.
So the plumbing gets a massive technological upgrade right as the macroeconomic rules of the game are being completely rewritten in Washington.
The timing is critical.
And we have to cover a major shift happening there that will affect the funding of everything we've discussed. Kevin Warsh has officially been sworn in as Donald Trump's new Federal Reserve Chair.
Yes, a significant appointment.
Looking at the reporting, Warsh, who previously served as a Fed governor during the 2008 financial crisis, brings a very specific platform to the role. He has been a longtime vocal critic of recent monetary policy. He has publicly pushed for faster rate cuts and major structural changes to how the institution operates. And he is stepping into this 4-year term right ahead of the June FOMC meeting,
Right.
marking what appears to be an era of highly intensified political and economic scrutiny for the Federal Reserve.
And the cost of capital dictates the speed of innovation. If the central bank alters its approach to interest rates, it immediately impacts the funding models for every single AI startup, every crypto infrastructure play, and every bank's back-office automation budget we have examined today.
This thing is connected.
The macro environment is the canvas that all this technology is painted on.
So we have gone from the massive offshore processing centers bleeding jobs to Claude, to Anthropic and OpenAI fighting block by block for enterprise dominance. We've gone to your Robinhood account suddenly trading on autopilot, all the way to stablecoins rebuilding the actual mechanism of the dollar.
It's a lot to take in.
So what does this all mean? When you take this entire stack of sources, what is the ultimate takeaway for you, the listener, as you navigate this new system?
The overarching takeaway is that the next decade of finance isn't about flashy app features, colorful charts, or gamified rewards programs.
No more dark mode interfaces saving the day.
Exactly. It is entirely 100% about trust. When human visibility is completely removed from the process, when an AI audits the corporate books, when a machine agent builds your shopping cart, when a stable coin settles a transaction instantly across a blockchain, the entire system relies on absolute cryptographic and institutional trust.
You have to trust that the invisible machine is acting securely and in your best interest.
Precisely. It is a complete leap of faith into the algorithms.
Which actually leaves me with one final, kind of terrifying thought for you to mull over as you integrate these tools into your own life.
Oh, boy. Let's hear it.
We talked extensively about Robinhood letting an AI agent trade for you, or an autonomous agent buying things on your credit card using these new machine protocols.
Right.
If you give an autonomous AI agent the power to control your money, and it hallucinates or it makes a catastrophic compounding error that bankrupts your account in milliseconds,
Which is technically possible.
who is legally responsible? Is it you for turning the agent on? Is it Robinhood for providing the platform? Or is it Anthropic who built the underlying model that made the mathematical mistake?
That is a massive unresolved issue.
The technology is already running the back office, but the legal framework isn't even close to an answer. Thanks for joining us as we unpack the future one node at a time. We will catch you on the next deep dive.
Spoken Tech for your ears.